In the midst of what could potentially be a once-in-a-generation financial landscape, we find ourselves at a crossroads of opportunity. It's often said that riches are forged in the crucible of recessions, and as we stand on the cusp of what appears to be an economic downturn, the truth of this adage becomes glaringly evident. The prospect may seem bleak, but recessions are not unfamiliar territory. They cyclically punctuate the financial markets. What sets this moment apart is the extraordinary potential it holds for those who are well prepared and well informed. Join us on this journey of financial insight and preparedness. Like, share, and subscribe to our channel as we explore the unique opportunities and strategies that this evolving financial landscape presents. Don't miss out on the chance to thrive in these challenging times. In the world of finance, famous people like Warren Buffett have praised the virtue of bad luck. For example, Buffett said, "Bad news is an investor's best friend." This quote supports the idea that market downturns give us chances to buy assets at lower prices and set us up for big gains in the future. So let's talk about what's going to happen in the next 12 to 24 months. The many benefits that smart investors will enjoy, and the exact steps you can take to make sure you're ready to get rich in these amazing times. But before we talk about the future possibilities, it's important to make sure we have the information and understanding we need to make the most of this unique financial situation. Before we start off on this path to financial freedom, we need to quickly understand the problems we might face. Let's start by talking about what a recession is. Some of the most common signs of a recession are a big rise in jobless rates, a drop in pay, a loss of customer confidence, and a general drop in the value of assets in many areas, such as stocks, commodities, energy, and services. A recession can have a lot of different effects, and these effects can last for a long time and affect the whole world economy. Along with the other economic signs listed above, a recession usually means that companies make less money. Companies usually share their earnings and give information about their plans for the future on a frequent basis. But recently, there has been a clear trend. Many companies have been lowering their predictions, getting ready for the chance of slow or even negative growth. Concerns about the risk of a recession are rising at the fastest rate seen in the last 10 years, and this cautious approach to guidance only adds to those worries. We've reached an important point in our conversation because of this new information. Lastly, a recession has an effect on the job market that causes a lot of people to lose their jobs. It is normal for people to spend less when they are making less money. Because there is less demand, businesses have to simplify their processes by cutting costs, which usually starts with laying off workers. Right now, a quick search on the internet for mass layoffs turns up a lot of companies that are trying to cut their staff. Bank of America says that the U.S. economy may soon lose about 175,000 jobs every month, which is a very bad sign. Now let's talk about what this all means for you and your investments, and how you can use this information to make your money better. First, let's take a close look at stocks. Right now, all three of the big stock market averages are going down, with losses running from 20% to 30%. Analysis from well-known people like Ray Dalio and others suggests that prices could drop another 20% from where they are now. Unfortunately, we need to look back in time to 1946 in order to fully understand the current market turmoil. When the market is unclear, the advice of financial experts rings true. As we try to make sense of this crazy world, it can help to remember what wise financial managers like Ray Dalio have said. People like them tell us that market bottoms usually happen when buyers give up all hope. At this point, the start of a comeback is usually signaled, which makes it possible for asset prices to rise again. Historical information reveals an interesting story. Over the years, the average drop during a bear market has been around 30%. The scariest part of this story happened in 2009, when the S&P 500, a measure of how well the market is doing, fell by an amazing 57% from its high point. It's important to stress that the effects are even worse when there is both a recession and a bear market. On average, the market drops 34.8%. You may be excited to know how much money a comeback like this could bring in, and I will get to that soon. But before we go any further, there are some important aspects of this financial picture that need our attention. You may be excited to know how much money a comeback like this could bring in, and I will get to that soon. But before we go any further, there are some important aspects of this financial picture that need our attention. The second thing we want to talk about is real estate. While it's clear that real estate markets vary a lot from place to place, it's also important to remember that big drops in home prices across the country don't happen very often. In the 60 years since the housing market began, there have only been a few times when prices dropped by more than 10%. On Wall Street, however, most people think that national home prices will drop by about 7%. In the worst case, they think that prices will drop even more, by 10% to 15%, especially if interest rates keep going up. As we learn more about real estate, it's helpful to remember what famous investor Peter Lynch said: the stock market and the housing market are two different animals. This wise words show how unique real estate markets are, with their local complexities and ability to withstand changes in the overall economy. Always remember that even though national trends can teach us a lot, each real estate market has its own unique characteristics. Moody's Analytics says that places like Florida, Arizona, Idaho, and Southern California could be the starting points of bigger drops, possibly up to 25% from their highest point. The drops could last for 12 to 18 months before they level off. People with fixed-rate mortgages who plan to stay in their homes for at least 5 to 10 years may not be affected much by these possible changes in the housing market. But for people looking for ways to spend their money or who want to buy a home, the way things are going could open up a lot of possibilities. Let's look at our third main point before we get into those possibilities. The big change in how people think about cash is interesting, and it supports the idea that when other investments lose value, cash becomes a safe haven. Ray Dalio, the famous investor, said it best: "Cash is no longer trash." This shows how cash's role in a diverse portfolio is changing. It is important to remember that cash was the best-performing asset class as recently as 2018. Keeping money in high-yield savings accounts would have been a smart move that would have earned more than the market as a whole. In financial accounts, cash is becoming more important. Even fund managers with a lot of experience are hanging on to more cash than ever before, since 2001. In its study, Citigroup says that cash is the only asset that buyers can rely on to protect themselves from a crisis. Now let's talk about how you can take advantage of these new possibilities and look at the reasons why many people miss out on the chance that's just around the corner. There are several reasons why this coming slump might be a once-in-a-generation chance. Benjamin Graham once said, "The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap." These words fit with the idea that when the market goes down, assets are priced more attractively, like a clearance sale in the financial world. Not only that, but when the economy is bad, there is usually less competition. As bigger companies cut back and adopt more cautious strategies, smaller, more flexible companies can step into the spotlight and make their presence known. One relevant example comes from a study of 17,000 businesses that showed those that kept spending money on ads during tough economic times not only kept their value but also continued to grow long after the recession ended. These views support the idea that being proactive and being able to see chances even when things are bad can help you get through rough financial waters. Let's look at the third important factor, which is about the chances that come up during economic downturns and recessions: opportunities. During a recession, it's important to understand that economic downturns and recessions can be the market's way of cleaning up and starting over. A smart investor correctly said that the market's peak was like an environment in a forest. From this point of view, the biggest and oldest trees, or businesses in this case, have access to all the resources, like sunshine in a forest. On the other hand, groups at lower levels have trouble fighting and growing. But just like natural forest fires are important for keeping the environment healthy by clearing out the underbrush, our economy goes through cycles that trim and rebuild businesses all the time. Companies that can't keep going are usually thrown out by this process. This makes room for younger, more flexible businesses to grow and develop. This event is a great example of Joseph Schumpeter's idea of creative destruction, which says that old structures and industries becoming obsolete makes room for new ideas and businesses to start up. Larger companies often cut costs by laying off workers and tightening their belts during recessions. Smaller companies and startups, on the other hand, are better able to adapt, come up with new ideas, and grab market share. In fact, history is full of cases of businesses that started up or did very well during tough economic times. Tech giants like Apple and Microsoft were formed when the economy was bad, showing that new ideas often grow when things are bad. Let's talk about the fourth important point, which is about how market trends have worked in the past, especially the change from bear markets to bull markets. Bear to bull transitions. Investors must understand how the financial markets go through cycles. History shows that there is always a bull market after a bear market. Yahoo Finance gives us useful information about these trends from the past. It shows that the S&P 500 has historically dropped by an average of 29% during recessions, with a normal drop of 24%. What's really interesting, though, is what happens after stocks hit their lowest points. On average, there is a huge gain of about 40% in the year after the market's low point. The market usually bounces back by an average of 58% in just 2 years. This information shows an important truth. Buying when the market is going down can be much more profitable than getting out of the market and waiting to see what happens. Also, it's important to stress how strong the market will be in the long run. Every time this has happened in the past, the market has eventually returned. This long-lasting feature of financial markets shows that having a calm, long-term view is still a good idea. Basically, these trends from the past show that financial markets go through cycles. It can be scary during bear markets, but they also pave the way for bull markets that follow, giving investors the chance to make a lot of money if they stay involved during tough times. Let's talk about the fifth important point, which stresses how important it is to act before most people learn about the coming changes in the economy. This includes using helpful tips from George Soros, another well-known financial expert. Acting ahead of the curve. One important thing to do during economic downturns and to take advantage of chances is to act before most people learn about the changes that are coming. This idea is in line with what famous investor George Soros, who is known for his accurate market predictions, says. Soros once said, "The way to make long-term gains is to keep your cash safe and hit home runs." Take the Great Recession, which began in December 2007, as an example. It wasn't made public until December 2008, which was only a few months before it ended. Because this wasn't realized right away, investors who had already made plans for the changing economy were in a better situation to make money. Also, the recession that came before the Great Recession started in March 2001, but it wasn't officially called a recession until November of that year. In economic cycles, this pattern of delayed proof comes up again and again. So what can people do to take advantage of this weight in recognition? Based on what George Soros said and what experts have said, here are some strategies. Keep up to date. Pay close attention to economic data, market trends, and the views of experts. Changes in job rates, shopper mood, and company earnings can be early warning signs that can tell you a lot about the economy. Soros's focus on protecting capital shows how important it is to stay ahead of changes in the market. Diversify and hedge. Keep your investments spread out so that they can handle changes in the market. Think about investing in things like safe stocks, bonds, and rare metals that usually do well when the economy is bad. These assets can protect you from losing money in other parts of your account. Plan for chances. Be ready to take advantage of chances that come up when the economy slows down. This could mean having cash on hand to spend when prices are low, finding assets that aren't worth as much as they're worth, or looking into new businesses that can do well when the economy is bad. Get help from experts. Talk to financial advisors and other experts who know a lot about how markets work. They can give you personalized tips and plans to help you handle economic uncertainty well. To sum up, one of the most important things you can do to make money during economic downturns is to be strategic and get ahead of the curve, using the advice of financial experts like George Soros. Even though recessions might not be confirmed for a while, people who are well-informed have a wide range of assets and are ready to take advantage of new chances may be able to handle changing economic conditions better because they are resilient and well-informed.